Hi. So in this lecture, we're going to talk about stock valuation. More specifically, we're going to talk about the dividend discount model. So that is something that may seem puzzling, but it is in fact quite simple, and it is in fact just doing the exact same thing we have been already doing, but implementing it in the case of corporations, or in other words, equity. So we are aware of the concept of value, and that the concept of value is just the present value of the future cash flows of any kind of asset. So in the case of equity, it is the same concept. The concept of value refers to what is the value of a stock in this case, is just the present value of the future cash flows that such firm, the underlying firm, is going to provide the investor or the stockholder, right? So now let's look at a very simple case that will help you understand what the dividend discount model is, and then we're going to move forward to something a bit more complex, and you will be able to connect both things and to understand everything in a very intuitive way. Okay? So let's assume that you go to the stock market and that you purchase, and I'm oversimplifying this, and that you purchase a stock, and once again you're very happy with your stock because they have given you a commitment of a fixed dividend. So the cash flows that the stockholders receive from a stock, we are going to refer them as, or they're known as, dividends, right? So they are just interest, or in other words, proportions of the profits of the company which are received by the investor. So in the case of preferred equity, there are cases in which you can have something such as a dividend that is constant. Now let's assume that in your particular case, these dividends are intended to grow in time. So they're not only constant, now they're not constant, they're increasing at a constant rate. What this means is you're going to receive $5 dividend, and next year you're going to receive $5 dividend plus some growth rate, 10%, 8%, 5%. Now, if you have this, you would be able to get the present value of such stock by using what we saw as a growing perpetuity formula. And the formula is just plugging the dividend that you were expecting to receive, and then the discount rate minus the growth rate. Once you do that, and if you want to see this more clearly and you are not quite clear about the formula of perpetuity, you can go back and look at the video in which we discuss annuities and perpetuities and the growing perpetuities. So if there is a stock which is providing or provided a dividend of 3.25, now let's kind of plot or just present this in some kind of timeline. So you received a dividend of 3.25. And now you are aware that there is a growth rate, or in other words, for the foreseeable future, you're going to receive increments, or this dividend is going to grow in a 6% growth rate. So this just implies the following. 3.25 times 1.06. The next year, you're expecting a dividend of 3.445. Then the following year, you're expecting a dividend of 3.6517. And then the following year, you're expecting a dividend of 3.8708. Okay, and I'm just going to leave it there. The growth here is a 6%. The growth here is a 6%. The growth here is a 6% as well. So the dividends are growing. The growth rate is constant, growing perpetuity. The growth rate is 6%, and now we have that the discount rate is 16%. So in this particular case, we're getting the value using the growing perpetuity formula. So I'm going to use this space here This is going to be D1. And let's keep in mind one thing. 3.25 is the last dividend of HT Corporation. And the following year, or the new dividend that you're expecting, is the last dividend plus a 6%, which is the growth rate, right? Now, you have 3.445, which is the last dividend, and the 6% increase, which is the growth rate that is expected for the foreseeable future. What is the concept of this fundamental value? What is the concept of these P0, or the present value of these future cash flows? Now, a keyword is future cash flows. So you cannot include the last dividend, because the last dividend, it was already paid to the existing shareholders, and so you're not expecting these 3.25, but you are expecting the 3.445. So your calculations for value should start with the 3.445. Okay? So that's why we use D1, which is 3.445, which basically is just D0 times 1 plus growth rate. Is it or isn't it? D0, 3.25 times 1.06, so we get 3.445. Then we just divide that by R, which is the discount rate, which in this case is 16%, minus the growth rate, which is 0.06. Once we do that, then we just get a value of 34.45. So this value is the value that is coming from the dividend discount model, assuming that these dividends are going to grow at a constant pace, so at a 6% for the foreseeable future. Now, what if you see that the market price of HT Corporation is 36.34? So in this case, the market price, or in other words, the price in which you would buy this stock if you go to the markets, is this, or you could assume it for simplicity, it is also the price at which you would sell this stock if you would go to the stock markets to sell it. Just in a very simple way. If you went to the stock markets to buy this stock, you already know that the fundamental value is 34.45. If you go to the stock markets to sell this stock, then you already know that your selling price is above the fundamental price, or the actual value, present value of the future cash flows of this stock. Hence, in this case, it is convenient for you to sell, because you would sell at a higher price than the fundamental price. It would not be convenient to buy, because you would be buying at a higher price than the fundamental value. So the fundamental value is the, let's call it the real value, the true value. Let's not use real to avoid confusion with nominal and real values, but it's the true value of a firm, and this is just what the market, or what investors are willing to pay for it. Sometimes market value diverges from fundamental value, and in those cases, such as this, it is convenient for you to sell, not to buy. So this case is quite straightforward, and it is simple. Now, we have a firm that is growing for the foreseeable future at a 6% growth rate. We have the last dividend. We can plot it. Everyone's happy. However, let's assume that we are evaluating the stock price of a startup company. So that startup company, they have not reached such stage in which they have consistent cash flows, but they are kind of more erratic, because when the firm is starting, there are certain factors that are still not stable, that are varying constantly. There is more volatility, so things are not so smooth. As a matter of fact, most of the stocks, you would need to have a more complex setting than just assuming this growing perpetuity setting that we just saw here. So in those cases, we will still forecast a moment in time in which that company will reach such stability. And once that company reaches that stability, then we can assume this model. In other words, we will have year 0, 1, 2, 3, 4, 5. In this particular example, and let's consider CT Corporation, we will have the first year, second year, third year, fourth year. And in the first 4 years, let's assume that this company is going to have some kind of volatility or some kind of fast-paced growth. Fast-paced growth because they're just launching a new product or new products to the market. They're doing very well, or they just opened a chain of restaurants which has been accepted by everyone, and so it's quite successful. So they are likely to experience an accelerated growth. But there will be a time in which people are going to get used to this chain of restaurants or to these new products. And at that point, the growth is not going to be as fast as in the first years, right? So in this kind of cases, which are most of the cases, we need to just segment things and split into two settings. The first, or the initial years, and then the stable years. So the initial years, we're going to take a couple of assumptions about coming from experts in the field or in the industry, coming from just analysis of the company's plans, and coming from what the company is expecting, the expectations of the company, and from the analysts. And we are going to be able to determine a couple of different growth rates. So in other words, let's say this simple. We are going to say this company is going to grow at a 40% rate for the first 2 years. Then it will continue to grow at a 25% rate. Then during the fourth year, it will grow at a 20%. So if you can see, the growth rate or the pace of growth is decelerating until they reach this mature stage, the stable cycle, in which we can go to what we did here, and we can assume after that point that firm is just going to grow at a 7.5% for the foreseeable future. That word just means forever, but we cannot say forever. We can see for the foreseeable future, okay? So how do we do this? First, there is no way with a single formula to solve for these initial years. So we need to solve these initial years one by one, and once the company has reached this stable point, we can use the single formula. Okay, so let's do this. We are just, and this is quite intuitive, we have that the last dividend of CT Corp was 3.5. So this is D0. Okay, so we have, it was 3.5. Now we need to forecast or to predict what is going to be D1. So in the first 2 years, we're told that that company will keep a growth rate of 40%. So this just simply means that we're going to have 3.5 times 1.4. So the dividend in the following year is going to be 4.9. So in the first year, you have 4.9 as the dividend, and then this growth rate will sustain itself for the first 2 years. So the following year, you're just going to have a growth rate of 40% again. So you just multiply 4.9 times 1 plus 0.4, right? And you will get 6.86. Now, the growth rate of 40% has reached its end. So when we move to the third year, now we will have a growth rate of 25%. So at this point, the boom of the new products of CT Corporation or of their brand new restaurants is decelerating. It's now at a slower pace of 25%. So we just assume that the dividend in year number 3 is going to be dividend at year number 2 times or increased by 25%. So 6.86 multiplied by 1.25. So that is going to be 8.575. Now, at year number 4, so people are even more used to the new chain of restaurants or to the new product, so the growth now is slower. So we just multiply it by the given growth rate, which is being assumed of 20%, and 8.575 times 1.2, so we have 10.29. Now, at this point, we are told that the company will start to grow at a 7.5% growth rate forever. Or in other words, for the foreseeable future. That's a better way to say it. Now, so in this case, we're going to calculate D4, which is the fourth dividend, and we're also going to need P4. So in other words, we're going to calculate the stock price at year number 4. Because at this year, now we can use this single formula, okay? So these are the dividends, and at this point, I'm going to make a line here. And let's say P4. So what is P4? And I'm going to keep these 4 here so that we do not forget that the price that we are calculating for this stock, we are attaining it for the 4th year. So once we get it, we need to discount it back to present value. But let's not confuse you with that. Let's just do the calculation of the price first. So our single formula to get the stock price, now that we know that the company will continue to grow at a constant growth rate of 7.5%, is just D1 divided by the required return, which is in this case 18%. Okay, it's different from 16% we saw here before. We have 1.818, and then we're going to subtract the growth rate, which now is constant. It will remain constant, 0.075. Now we need D1. So at year 4, this dividend is the dividend that already took place. And our formula needs D1, which is the dividend in the following year. So we are going to calculate D5 only for the purposes of getting this P4. The price at year number 4, so then the D is going to be basically D5, right? Now what is D5? D5, we can calculate it by doing the same thing, just that the growth rate is going to be 7.5%. So 10.29 times 1.075. That gives us 11.06. And that is our D5. Now, let's mark these 11.06. And I'm going to write here only for P4. So we are only going to use this to calculate P4. Okay? Now, P4, and I'm going to continue with this marker because it's more clear. So we have D5, and we already have D5. So it is going to be 11.06 divided by this 0.18 minus 0.075. Okay? And which is going to give us 105.35. Okay. So we got P4. Finally, let's do this. Okay? So we have this timeline, and this may look familiar. We have a timeline of cash flows, And if we want to find the value of an asset is just the present value of all of the cash flows. We already have the cash flows. So we are going to ignore this one, D0, because it already happened, right? So the price or the present value, or the price or the value of an asset, it's the present value of all of the future cash flows. If this already happened, we can ignore this. But D1, D2, D3, D4, and P4 have not occurred yet. So what we are doing now is just getting the present value of all this. So this is going to be 4.9. So 4.9 is occurring next year, 1 year. So 4.9, we're going to bring it to present value, and we're going to discount it by the discount rate here, which is 18%. Okay? Divided by 1.18. And then we will move on to the second dividend, which is 6.86. And now this is going to be discounted using the discount rate and using the exponent, which is now 2, because this is coming from year number 2. Here, if you want, you can just use a 1. So the year is the first year, so it's basically the same. Then you move on to 8.575, which you're going to discount like this, because it's coming from the third year. And then we have year number 4. So I'm going to give you a hint, which may help you to understand this. Let's just assume when you're using the dividend discount model and you have this stage of growth, which is supernormal growth, right? So let's assume that you're just waiting for the 4th year. In the 4th year, you're going to sell this stock. So you will receive dividend 1, you will receive dividend 2, you will receive dividend 4. You're going to receive the 4th dividend in the 4th year. And in the 4th year, you will go ahead and sell that stock. So what are your cash flows in the 4th year? And I'm just going to make this like this. 1st year, 2nd year, 3rd year, and then 4th year. So in the 4th year, your dividend is 10.29, and you will discount it at 1.18, and the N is 4 because it's taking place in the 4th year. In the 4th year as well, you will sell the stock. This is just, we're assuming. And so you will also receive the price of the stock at year 4. So what is the price of the stock at year 4? It was D5 divided by R minus G, so it is 105.35. So you're receiving 105.35, and you're going to discount it 1.18 to the power of 4, because it's also taking place in the 4th year, right? So at this point, we have all these numbers, and we can get the values of these numbers, and I'm going to write them on top here. So the first year, the present value is just 4.15. Then the 2nd year, the value is just of this discounted dividend is just 4.93. Then during the 3rd year is 5.22. And then in the 4th year, you have 2 things. So you have the first thing, which is 5.31. And you have the 105, which you're discounting, and now you're going to get 54.34. So when you add up all these future cash flows, you will get a price 0, which is 73.94. And this is it. So again, we are just taking the present value of D1, then the present value of D2, then the present value of D3, then the present value of the 4th dividend, D4, but we are assuming that we are selling the stock. Or in other words, we need to add the value or the price of a stock at this point, because we will stop our supernormal growth and we will start assuming the constant growth or the long-term growth. So at this point, we will also add this 105, which is P4, which is the price of a stock at P4. And we will also discount it 1.18 to the power of 4, because this is also happening in the fourth year. These values give us these outcomes. This is the fourth dividend, and then this is the price of a stock at year 4. We add all of these and we get the present value or the price of this stock according to the dividend discount model. If you forget P4, we're going to get it using this formula. So it's D1 divided by R minus G by discount rate minus growth rate. So if we're in the year number 4, you want to know the price of a stock in year number 4, then your D1, if you are already in year 4, your D1 is now D5, right? Because you are already in the fourth year. So your D1 now is your D5, right? So that's why if you have P4, then this is D5. You divide it by the discount rate minus the long-term growth rate, and you will get this D5, and you will get the price of a stock at year number 4, which is what you're going to add here. Once you do these numbers, you will get the price of 73.94. So if the stock price of CT Corp, which is this company, which just launched a new chain of restaurants or a new product, if CT Corp's stock price is above 73.94, it may not be such a good idea to purchase that stock at that time. But if the price of CT Corp in the market is below this fundamental price of the stock, then it may be a good idea. It may be in your interest to just purchase that stock, because market prices will eventually converge to the fundamental price, or in other words, to what these future cash flows are worth today. So I hope this is useful for you. We have gotten some kind of the idea behind the dividend discount model, and we will continue to do a couple of more exercises so you are acquainted and you feel familiar with these exercises regarding stock valuation. So thank you very much for your attention, and let's keep in touch.